Inventory is down for the second week in a row. It's the middle of November, so you'd expect that. But since mortgage rates spiked in early September, inventory has been climbing. So with mortgage rates over 7%, demand stopped cold. And the fact that inventory is ticking down now again, that's a bit of a relief. Inventory is down not because people are buying homes, of course, but because some sellers are not getting the offers they need, and so they're pulling their homes from the market. But either way, supply declines. So the supply-demand equation is a little more balanced, at least. Declining inventory also is a signal that there are not any waves of new inventory, maybe from panicky sellers or investors or something like that. We don't really see any of those waves, at least not this fall, happening. Each week, Altos Research tracks every home for sale in the country. We analyze all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. If you aren't using Altos market reports with your clients, your buyers and sellers, right now might be a good time to step up. Go to altosresearch.com, book a free consult with our team, because everybody is worried about what's happening in the market right now. And they need you to help them see clearly. So the data we cover here in these videos is national, but it is available from Altos for every zip code in the U.S. So join us to dive in. I'm Mike Simonsen. I'm the CEO of Altos Research, and here's what the data looks like for the second week of November 2022. There are now 571,000 single-family homes unsold on the market. That's down less than 1% from last week, so just a little downtick, but it's down. Inventory peaked 2 weeks ago at 577,000. There are very few new listings hitting the market right now, even fewer than normal for middle of November. There are some going into contract and some being withdrawn. And as a result, though, available inventory of unsold homes ticks down a little bit. You can see at the far right end of this chart, this summer inventory seemed to have topped, started down, and then it started climbing again when rates spiked. So inventory finally hit its peak for the year at the end of October, right at the end of October. So 2 weeks of inventory decreases now. With the holidays rapidly approaching, we can assume that inventory won't climb again until after New Year's. And this is actually what it looks like through the end of the year. Inventory is likely to end the year about 520,000 single-family homes on the market. The dark red line here is this year's curve, and you can see the inflection point on September 1 when rates spiked, and then demand halted. That's inventory started climbing again. The dotted part of the line is where inventory is likely to trend through the last 6-8 weeks of the year. With better than expected inflation numbers last week, mortgage rates dipped back down too. So it's too early to see the impact of that quick mortgage rate adjustment, pretty dramatic, in the inventory data. But if you want to see one perspective on what inventory might do next year, you can watch the replay of last week's Altos Research webinar. That webinar is posted here on the YouTube channel. There's a little section for webinars. Go check that one out. And in it, we share the model, what a model might look like for next year. And that's assuming, of course, we don't know where interest rates will actually end the year. But it's a model, and you can understand, you can look and see how close to normal we might get back with inventory. So the median home price in the U.S. is now $422,900. That's down 0.25% from last week. Prices will tick back each week until the end of the year. Should be end the year about $400,000 median home price in the U.S. There are very few new listings each week right now, as I mentioned, but those that came on the market this week, We're priced at a median of 374,900. That's actually unchanged from last week. So just a smidge under 375K. That psychological threshold is what keeps it unchanged week to week. But that'll actually keep sliding down through the end of the year as well. The new listings are the light colored line here. And you can see we'll have a couple of big holiday down spikes over Thanksgiving and Christmas to come before we see after the New Year's if anyone's going to buy houses in this country at all. We can also see the shock of the September mortgage rate spike has maybe started to wear off now, that shock. So we can look at that price reductions to see this. The percentage of homes on the market that have taken a price cut recently. Right now, nationally, 43.2% of the homes on the market have taken a price cut. That's basically flat from last week. It's up just a tiny bit, less than 0.1%. So it appears that price reductions have almost peaked, maybe peaked. One reason that price reductions will curve down for the rest of the year is that if a home hasn't sold and it's not getting offers, it's actually growing much more likely to be pulled off the market. So then starting in January, we'll see relists and we'll see price reductions rise again as we see some of those homes back on the market. But for now, it looks nationally like price reductions have probably peaked for the year. The rate of price reductions is always local. It's always, for example, higher in Phoenix than it is in San Diego. And right now, it's way higher in some of those local markets. 68% of the homes on the market in Phoenix, in the city of Phoenix, have had price reductions as of this week, 68%. Because the buyers have stopped cold, the inbound immigration has stopped. Those buyers are not competing for those local homes right now. Buyers have stopped cold all over the country, of course, but for the markets whose inventory was kept in check by the inbound migration buyer, those migrations have stopped. So inventory builds in Phoenix and Austin, but it's not really building in New York or Cleveland or Chicago. In fact, the rate of new sales, which we can measure by tracking the pendings, the new pendings each week, the homes that were on the market last week and are now in contract this week, the new pendings rate is almost as low as Christmas week when nobody buys houses at all. There are only 314,000 single-family homes under contract right now, and about 50,000 new pendings this week. And in this chart, each bar is the count of pendings each week in contract, the count of properties. And the light red portion of the bar are those newly in contract this week. So you can see how each week the total number of pendings is falling, and each week the number of new pendings is very, very few. And so that has implications. Those are sales that are not yet complete. Those are pending contract. And those may fall out of contract and go back on the market, or fall out of contract and stay off the market until after January. But either way, that's the number it's the smallest number since the early part of the pandemic that are in contract right now. The demand is just shut off, and supply though is contracting too. So the market's basically holding its breath until after the holidays, and then we will see where the world is at that point. This is, of course, national data, and the local markets, as I mentioned, are behaving very differently from one another right now. If you need to get your local data to your buyers and sellers, you should join us at Altos. Go to altosresearch.com, book time with our team, learn how to interpret the crazy market for people who need it right now, get the local data for your customers in your local markets right now. You need to be the expert for them. So we look forward to working with you. That's all the time we have for this week. More next week.